Then I directly want to move you to the next presentation, and I would call Mr. Godfrey to the stage. I see you. So please come to the stage.
In Ethiopia, because this morning we had consolidation, too small. But what is too small? Is it your office building? Is it the number of people that you employ? So, in 1996, there was this story of the Asian flu. That was a monetary issue to do with weak currencies of the Asian economies. They learned from that. Today, they're in a different space. In 2007, the world experienced the global financial crisis. And there's been a lot of write-up. First, they blamed investment banks, mortgage houses. They talked about greed, bad performance metrics. But one thing that they didn't say, that banks at that time were not well capitalized. They were not well capitalized. But why? Then, not long ago, I remember it was the Christmas of 2022. Something also happened in one of the strongest economies. That was the Swiss National Bank asking UBS in 48 hours to take over Credit Suisse. These were enormous banks. But what was the imperative? So when we talk about small, what is it that we are talking about as being small, and what are we addressing? I'm not going to focus so much on my presentation because most of the things that are in there have been talked about. But truly, again, in the case of Credit Suisse, it was the drop in Tier 1 capital from 20.3% in 2021 to 20% as a ratio in the year 2022. So you can imagine, if you look at the numbers, a 0.3 change, why would that trigger a takeover? And a policy decision by the central bank to do so. So the issue around banks and financial sector is the ability to bear risk. And who bears that risk? And that's why in most of all these regulations, the Frank-Dodd, the EU, one fundamental principle has come about: your capital adequacy. And all banks in the EU, they do the testing almost every year on that capital adequacy ratio. And where does it come from? It comes from Tier 1 capital, because that is the first buffer of loss. So as a bank, if you are unable to bear that risk, you don't have that buffer. Your balance sheet, you have a balance sheet, but your Tier 1 capital, which composes of retained earnings, common stock, cumulative and non-cumulative preferred stock, then you have a risk. And it is in that regard that you are small. So it's not the branches that you may have, it is on the basis of your Tier 1 capital, because the shareholders of that bank are the first guys to lose. Because we all know when you put in equity, you bear the risk of losing the business, right? Anybody else hasn't that risk. The lenders are much more protected than you are. So there is a slide There's a slide that I would like to talk to, actually two slides that I would like to talk to, which is this one here, which addresses really the core of the capital markets. The structure of capital markets is very critical. And that's why it is always very important to look at this in an integrated way, because global financial businesses or sectors are integrated and segmented. Integrated in a sense that when you look at your first level of the primary capital market, where you go issue your shares, your IPO, that is basically the first point of call to mobilize capital for your protection. So privately held institutional banks that have no access to get to the market to create that capital will always have a smaller capital base. Then you have where you talked about liquidity and all that. That is in the secondary part of the capital market, where there is that trading every now and then, passing on risk from A to B as and when it is possible. And in doing so, you are again buffering up your equity base. Now, in most cases, you have the derivative market. That is another important source of your capital. As you would remember, you'd have your COCO bonds, contingent claims on Tier 1 capital. That, again, is another source of equity. Now, in the absence of a vibrant, robust capital market, you are constrained from raising as much equity as you would have because you have only mobilized from a few people or a few shareholders who have also limited resources. Why? Because they don't want exposure to too much risk. So this is complementary. Without this kind of structure embedded in any capital market, there will always be risk of capital flight and low liquidity, as we will later see which is common to most African capital markets, with the exception of Johannesburg, which is very big, based on a big economy. All the others face one challenge: low liquidity, very few listed companies. If you compare the number of companies that are listed on one of our stock exchanges, so South Africa, you have about 600 companies. Compare that with on the AIM in London. 600 is a small number. So the mobilization of capital from the lowest level to support SMME, to support all that, is embedded in the capital markets. That's why it's very difficult to grow an SME in our environment, because the capital base is so small. Now, as we move on to the points that I was talking about earlier on, I think this has been discussed. I've talked about that in broad terms. You can also see, again, in terms of the tiering of our capital markets. African capital markets are not homogeneous. They are heterogeneous. They are divided into three areas. You have the kind of most advanced, like South Africa. You have the emerging, as we would point out those, and then you have the frontier. Each of these suffer their own shortcomings. However, when we look at what we see here, this is really a summary of what happens in all these markets, the trading, and all these aspects that we're talking about, capitalization. So that talks about that. So now what we need to be focusing on today in my presentation is this slide that I'm getting to. Should be, really talks about the sizes of our Tier 1 banks. How much capital do we have in each of these? I'm just looking for it. It looks like it is missing there, but in a nutshell, if I can speak to it, In Africa, out of the top 100 banks defined by Tier 1 and total assets, the biggest, which is Standard Bank, has about 13 billion in Tier 1 capital, the one that I talked about. The next one is NBE, the National Bank of Egypt, which has about 10 billion. And actually then followed by Bank Misri, then you have ABSA, and all those fall below a $10 billion mark of Tier 1 capital. Earlier on, we talked about what happens in East Africa. In East Africa, you only have Abyssinia, Awash, in around 60 and 80. In Kenya, you have KCB, whose actually Tier 1 capital is under $500 million. So when we talk about size, it is in that context that the ability to bear risk is so low. And because of that, it is difficult to attract capital from anybody else because from day one, you are seen to be risky. You are unable to bear risk in times of a bad business cycle. Now, as a result of that, what is the imperative that we should be talking about? We should begin looking at our economies, our policies in a very integrated way, in a way that really protects all sectors and all institutions in the financial sector. Because capital flows from insurance companies to banks to capital markets, and vice versa, from capital markets to financial institutions, to businesses, and to insurance companies. So there is no singular approach that we should seek to think that it will work. It's multidimensional. Once it's multidimensional, then we will see the protections that we seek. We will attract foreign capital. We will attract investors in our sectors. It was mentioned earlier on, the need for regulation. There is regulation in the capital markets in a number of places, but it is not integrated because it is this piece, that piece, that piece. More importantly, what is also required to attract that entry and open up the financial sector is to have a coordinated approach, not adversarial. It must be collaborative between private sector players, regulators, policymakers. None of those is independent of the other. Once there is that coordination across all those parties, then we manage risk. We take away the risk aversion because they do not, investors or foreign entrants do not look at one variable. They always look at a portfolio of risks. So as a sector, you don't have one risk. You have a portfolio of risks. And a coordinated approach to addressing that portfolio of risks is one way of opening up entry into the sector. No single solution that is not coordinated, that is not collaborative, will take away that risk. So I think with that, I'll rest my presentation, and I'll be glad to take questions at the end of the session.